Welcome to the Daily Drawdown, where today the tape runs on memory, Capex, and rates. The market keeps calling this earnings season, but a lot of the real signal is elsewhere. Who can secure memory, who can fund compute, and whether rates stay high enough to punish everyone else. SK Hynix just pulled off a huge U.S. listing, raising about $26.5 billion through an ADR sale. It was the biggest foreign U.S. share sale and the largest ADR debut on record. Demand was the story. The book was roughly 7 times oversubscribed, and the ADR opened at a sharp premium to the Sol line, showing both retail appetite and strong cornerstone demand. Why it matters is simple. This is the cleanest public market expression of the AI memory shortage, and U.S. investors were willing to pay up for direct exposure. There's also a flow angle. Analysts estimate as much as $14 billion of passive index inflows once the ADR lands in major benchmarks, so the listing itself can keep supporting demand. Near term, though, expect noise. Options, leveraged ETFs, and concentrated hedge fund positioning are amplifying moves, so this name can trade like a momentum product even when the fundamental story hasn't changed. Underneath that IPO pop is a supply chain that still looks tight for years. SK Hynix controls roughly 56 to 58% of high-bandwidth memory, with Micron and Samsung each around 21%, which leaves Hynix in the key seat for AI server demand. New fab and packaging capacity won't really hit until late 2027 or 2028, so the shortage in HBM is not a short-term problem. Multi-year DRAM contracts are already tying up capacity through 2027, which limits spot flexibility and helps keep pricing firm. Packaging is the real choke point. Companies are spending heavily there, including Hynix plans around advanced packaging and a roughly $4 billion Indiana site. But power, water, land, and labor constraints still slow the ramp. What to watch next is whether the market starts looking past scarcity. Over the next 12 to 24 months, capacity additions from Samsung, Micron, and Hynix could eventually pressure pricing, and a shift from HBM-heavy model training toward lower-power inferencing could change who benefits most. The broader market frame right now is Capex season. Instead of traditional earnings surprises, investors are increasingly judging hyperscalers on how much AI infrastructure they're willing to fund and whether that spend can turn into durable revenue. Meta is central to that debate. Commentary around the company points to a very large AI investment push, with plans to materially increase AI Capex and potentially double it by 2027. The more interesting part is the monetization path. Meta is moving towards selling or leasing excess compute, which starts to make it look less like a pure ad company and more like a cloud competitor with an API business attached. That matters because it gives investors a way to justify enormous data center spending. If excess capacity becomes a recurring revenue stream, Capex starts looking more like asset creation than pure expense. The risk is that cheaper tokens and APIs can drive more usage, not less infrastructure demand. That Jevons-style dynamic is why the market keeps talking about gigawatt-scale AI campuses and entirely new categories of income-producing AI infrastructure. Positioning is already aggressive. Meta options volume has surged, with call buying dominating and a lot of activity in short-dated strikes, which tells you the market is leaning hard into a near-term bullish read. At the index level, the tape looks flatter than the internals. Breadth has improved with about 2/3 of S&P names recently up and the median stock gaining close to 10% over 2 months. That broadening matters because it reduces some of the concentration stress that defined the first leg of the rally, even if a lot of the actual money is still chasing AI-adjacent winners. Small caps have also held up better than many expected, even outperforming the S&P on a trailing 2-year basis, though the strongest part of that move has been concentrated in profitable AI-linked names rather than the whole Russell universe. Within tech, there's been a tactical rotation. Semiconductor momentum cooled in July while fresh inflows moved back into mega-cap platforms, and some strategists are using the Mag 7 staying above its 200-day moving average as a simple support check for continued tech leadership. Valuation is where this gets more nuanced. NVIDIA's multiple has come down materially, with commentary putting it around 22 times forward earnings, which is far less stretched than the market narrative implies. At the same time, names that ripped in the first half, especially memory and other AI hardware plays, have shown sharp reversals, with leverage and options flows amplifying everything. Earnings and capacity updates can produce outsized moves in either direction. The bigger caution is expectation risk. The market is already pricing very strong growth, and heavy fund inflows plus record insider buying support the rally while also concentrating the pain if results miss. On macro, the biggest practical signal is still the long end of the Treasury curve. 10-year yields around 4.5% remain the discount rate anchor for almost every growth asset in this market. Fed Chair Kevin Warsh announced 5 task forces spanning jobs and productivity, balance sheet sizing, and monetary tools with a mix of academics, former central bankers, and private sector technologists. The balance sheet group stands out because it's expected to study how to shrink oversized central bank balance sheets and report by year-end. That suggests institutional interest in structural reform, not just the next meeting. For markets, though, the simpler takeaway is that expectations still lean toward at most one modest rate hike this year and no meaningful easing cycle. If long yields stay elevated, expensive duration trades remain vulnerable, no matter how good the AI story sounds. One other development with real market structure implications is stablecoins. Circle got OCC approval to operate as a national trust bank, which lets it hold USDC reserves directly and simplifies state-by-state compliance. That's important because stablecoins are moving further into the regulated financial core, just as banks and payment networks are building their own tokenized dollar products. The next step people are watching is tokenized equities and near-round-the-clock settlement. If platforms can offer actual U.S. equity entitlements rather than synthetic exposure, that starts to pressure assumptions around exchange hours, settlement plumbing, and who owns the customer relationship. Finally, oil has been more resilient than a lot of macro bears expected. WTI has hovered just under $72, even with geopolitical noise and uncertainty around OPEC+. The key detail is refining, not just crude supply. Outages and Ukraine-linked strikes have hit a large share of Russian refining capacity, tightening gasoline and diesel markets and supporting product margins. At the same time, the IEA says 2024 marked the first annual decline in global oil demand since 2020, so the energy picture is not a clean, bullish supply shock story. It's tighter products, softer demand, and a market still trying to price both at once. That's the setup. Memory scarcity, AI Capex monetization, a broader but still fragile rally, and rates doing the real policing. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.